investments for 2021. One of the things that we need to talk about really is just strategies for investing. When we talk about strategies for investing, it's not always which stocks are hot and which one or two things can you pick to double or triple your money so the rest of it doesn't, if it doesn't do as well, you still have a good average return. So I'm not here to do like stock tips and tricks and things like that, but really talking about models and developing portfolios and what considerations we need to take currently in 2021 when developing these. So our agenda tonight, hopefully we can get to all of this in roughly 30 to 40 minutes. I'll have Q&A at the end. And again, feel free to ask questions throughout the presentation, and I'll try to address everything. But we're going to go pretty systematically. We're going to start with basics, stocks versus fixed income or stocks versus bonds. We will then talk about money management styles. So if you choose like a mutual fund or an ETF to invest into, what's the difference between active and passive investing? We are going to talk about current bond yields and interest rates and how raising interest rates or what the Fed has indicated that they will do, over the next couple of years, how that might affect bonds or how that might affect fixed income. We'll talk briefly about a recovery economy, what that typically means. Mostly we're going to be talking about hurdles here, but with hurdles come opportunity. So a lot of times when you dig into some of the problems we're having, we can pretty easily find some solutions to those problems. Once we talk about those first four things, that kind of builds context for developing a portfolio. Now we're going to talk about time horizon and dollar cost averaging at the end of the presentation today. These two things are pretty critically important when developing a portfolio, for a client, or if you're developing your own portfolios, this is important too, to understand not only the time that you have until you need this money, but how much time do you want to take integrating a strategy so that you don't potentially harm yourself jumping into something with, both feet and body in the water all at the same time. So we'll get right started into this. Again, if you guys do have questions or anything like that, you can use the chat and we will address everything as we go. So very, very basic concept to start everything off first, stock versus fixed income or stocks versus bonds, okay? I almost always would like to start an educational portion of a client meeting with this. So what are the two most common things you can invest in? Well, stocks are a representation of ownership within a company. If you purchase a stock, you own some of that company. You get to vote on some of that company's voting rights. You can elect the board of directors. You can, vote on non-executive compensation. You truly do own a portion of that company. You even get invited to shareholder meetings if you want to. Now, when you own stocks, because stock value is typically based on projected earnings of the company, if a company ever has low projected earnings or there's not a good outlook for that company, stocks usually represent a little more volatile of an investment. It would move higher and lower on a basis than a traditional investment would. Sorry about that. Stocks are typically easily purchased and sold within an account. They're very liquid investments. You can buy and sell in the same day sometimes if you want to. I'll always tell people the stocks are more of a long-term strategy. If you're building a position in a company or building a position in a variety of different stocks, usually you want to be able to hold on to those individual holdings for 5 to 10 years. Unless you want to become a day trader and purchase something in the morning and sell it in the afternoon and have that become your day-to-day job. Much more often what you're looking for is stocks that you can take a good position in over time and hold on to it for several years. Jim Cramer of Mad Money always preaches, when building a position, hold on to it. I think Warren Buffett says that you need to be comfortable holding on to stocks for at least 10 years. So pretty sound advice from some industry experts. Of course, with stock investing, you have more appreciation potential. This just means with that volatility comes the opportunity to earn a little bit more than you would be by using fixed income. So that's stocks in a nutshell. It's ownership of a company. You have shares, you have rights. Fixed income or bonds represent company debt. Fixed income and bonds specifically, we're going to be talking about later in the presentation and how these values are illustrated differently than stocks. But this is company debt. If you own a bond, you own debt in a company. You are part of their accounts payable. So they owe you money every single month. Bond income or debt service is what that's called. So you loan a fixed amount to a company or government entity. They pay you interest while using your money for whatever operations they want to use it for. Most times the principal is returned to the investor. There are caveats to that. There are caveats to almost everything. When I say most times, you can have bonds that lose value. I mean, if anybody went through 2008, you probably had a bond that went down in value a little bit. So most times principals return to the investor. Sometimes it's less than what you put into the account. Greater principal preservation means lower growth potential. So greater chance of holding on to the money that you put into the account. However, lower chance that you're going to have years with double-digit rates of returns. 10, 20, 30, 40% years are not typical for a bond. So stocks versus bonds, stock versus fixed income. Anybody have any questions on just the basics of that?
General, which protects your purchasing power from inflation, bonds or stocks?
Very good question.
Can you repeat the question, please?
Yeah. So the question was, which of these, either stock or fixed income, best protects your purchasing power from inflation, bonds or stocks? Typically the strategy has been, when you want protection, go to bonds. When you want preservation, go to bonds. And when you want things that are going to be relatively safe, you would go to bonds. Now, protection from inflation, the power of inflation, it depends on where you think inflation is going to go. If you think inflation is going to be relatively muted, then bonds can definitely protect you against inflation. If you only expect inflation to go up 1% to 2% per year, bonds can keep up with that. Well, what we've been finding recently is with inflationary pressures rising and interest rates going up, even if you want to hedge the large majority of your money in fixed income in order to protect against inflation, you, at this point, almost always have to have at least a small component of your portfolio that's exposed to some riskier assets. And the purpose of that isn't to say stocks are the end all be all, but yields are so incredibly low on fixed income right now. It's really, really hard to justify them as a hedge against inflation if they're not paying anything. If you pay 1.5% to manage your money and a bond yield's only giving you 2%, well, what are you going to do with the 0.5%? You can just as easily go put that in the bank and then not invest it. So I think traditionally people have used bonds. I think maybe in the current monetary environment there needs to be a small stock component to it, and you can still have stocks that are relatively stable that kick off dividends. It doesn't mean that it just has to be growth stock, but bonds just aren't quite getting us there at this point. So yeah, 100% bond portfolio at this point, I don't think achieves very much, as opposed to how it would traditionally have, diversified a portfolio. Good question.
Thank you, Nolan. That's all we have so far for questions.
Cool. To piggyback on that, what I wanted to do is I wanted to show you guys stock versus bond annual returns. Now, it's been told to me, we always have to take our industry experts with a grain of salt, but it's been told to me that bonds are used as a portfolio diversifier, right? I mean, that's what we use them for. That's why you have a portfolio that's part stocks and part bonds. And what it's always been told to me as justification for that is because bonds behave differently than stocks. Okay. Now let's go through 100-year history of some bonds. Okay. Now you may be completely correct in that they provide some diversification benefits, but I would like to pose a question to everybody that's here. If you look at areas like this, and this, and this, and this, and I'm just going to go completely along this chart and circle every single little piece of anything that I would say has correlation. If you're developing a 60-40 portfolio and you think that your bonds are a significant differentiator in your portfolio, the only true differentiation that they've been able to provide on a consistent basis is underperforming stocks. Okay, and that's it. To me, this looks totally random. I can't take any information from this chart and tell you what next year is going to be like, because it seems like every 2 or 3 years, bond returns mimic stock returns, and they only do so in a muted manner, meaning the losses aren't quite as big, but the gains aren't quite as big either. And if your goal is to get 15 or 20% of the gains and 15 to 10% of the losses, bonds are a really good way to do it. But if you think that every single year the tried and true bonds are inverse of stocks, I would just show you this chart and say, well, they're inverse sometimes, but a lot of times they're not. A lot of times there's heavy correlation between the two, and the only difference is bonds underperform. So, take this with a grain of salt. What I'm talking about here is kind of piggybacking on the stocks versus fixed income. A totally fixed income portfolio, while it may have had merit in the past, it just looks like it's a little bit more connected to stocks to me. So if you're going to ride some sort of volatility, or if you're going to have variance in your portfolio, why wouldn't, if you're going to take the risk, if you're going to lose the money, why not take a little bit stronger of a stock position? At least that way you have the potential to grow a little bit more, rather than just getting the 1, 2, 3, 4, 5% bond years. So that's just what I wanted to show you guys here in this chart, is that there's plenty of times when there's heavy correlation between stocks and bonds. There's plenty of time where there's not heavy correlation, and there's plenty of times when stocks go up and bonds go down and vice versa. But to say that it's a rule, I just want to see it means tested. I want to see the rule in action. All I see is bonds muting portfolios and not doing much more than that. So yeah, it's tough out there, especially when bond yields are so low, and it's relatively unpredictable what performance is going to be. So questions about this chart? I know it's kind of straightforward. It's 100 years worth of history, so extrapolate.
So far, no questions.
Okay. If you do, happy to answer them at the end. We're going to talk about portfolio design and how this kind of fits into it in a little bit too. So we'll keep providing context here. Okay, active management versus passive management. Now that we've talked about the difference between stocks and bonds, we now have to talk about management styles. So you've determined, okay, I want a portfolio that's mostly stocks, but I still want bonds because I don't want to ride the wave all the way up and down. If 2008 happens, I don't want to go down 40%. If 2020 happens, I don't want to go up 35%. Okay, so we've started to piece together a portfolio for you. So now you get a choice when you're choosing the types of assets that you want to put into your portfolio of whether you want these assets actively managed or whether you want them passively managed. And there are two main ideas here. Active management is basically a fund manager that you either hire as a financial advisor, or we can even pick when we're picking funds out for you. We can pick active versus passive managers. But active managers do continual due diligence. They must be aware of micro and macroeconomic trends, big into economic forecasting. They usually take on a theme for the investment style. So a theme of an active manager might be genomics, where their entire goal is not only healthcare investing, but specifically gene sequencing, because they believe over the next 10 years, gene sequencing is going to be a prevalent investment opportunity. That would be a theme. You want to invest in science, but then you pick a sector and all the different investments within there will fall in line with that theme. Active management is typically meant to outperform indices over time, and will almost always have a higher fee. So you do pay a little bit more when you choose active management as opposed to passive management. Now, passive management, and either of these strategies can be used in stocks or bonds. They are not unique to any of these structures. So you can have active bonds, active stocks, passive stocks, a blend of each, it doesn't matter. Passive management involves systematic, unemotional rebalancing. Target date funds and 401ks are common passive managers. If anybody knows how a target date fund works, it's a blend of stocks and bonds. Every single 5-year period, they get less aggressive, and then they get a new target date fund that's much further out than all the other ones. So if we roll around into 2025, your target date 2025 fund is almost going to be completely bond based. Your 2020 fund right now is almost completely bond based. Well, we just went over how bond yields aren't really doing all that well, and they might not be all that great in the future. But for a target date fund, it doesn't matter. They have a rule that every 5 years, they are going to get less aggressive, and they will do that no matter what the conditions are in the market right now. So when market times are good and it's relatively easy for blended portfolios to do well, target date funds do awesome. But if they rebalance into more bonds and we're in a rising interest rate environment like we currently are, bonds may not be the best place to go. So you may want to change your target date. Passive managers may invest into a sector that's bearish regardless of performance. Like I said, lower fees typically with passive managers because it's much more of a set it and forget it investment as opposed to an active manager that's going in on a daily or weekly basis, changing the holdings. You can reduce fees by having passive management in your portfolio in addition to active management. So that's active versus passive. That's kind of the next step in, okay, I figured out how, what stocks are, what bonds are. Now I need to figure out how I want my stocks and bonds to be managed. Do I care more about somebody trying to beat the market each and every year? Or do I care more about just, the turtle and the turtle versus the hare? And I would much rather place my money somewhere for 10, 20, 30 years and assume that it's going to be okay at the end of that period. Okay. So questions on active versus passive. Some common questions that I do receive to head off any questions are which one works better? It depends on the year. In 2021, what we're doing is a blend of active and passive management with the idea that a blended approach will most likely outperform any one individual one just simply due to market volatility. Very volatile markets usually make active managers underperform passive managers and vice versa. Really volatile markets make active managers outperform passive on the upside. So in years like this year, where there's a whole lot of uncertainty, we're typically doing some type of blend of active and passive money management in almost every portfolio. So happy to talk about those, happy to talk about target date funds. If we don't have any questions on those.
I do have one quick question, Nolan, actually. So Ken actually wanted to ask about self-directed IRAs. If you're thinking about investing, could you use those self-directed funds or IRAs or private REITs, et cetera, to do some of this stock market things that you were discussing earlier?
Yeah, most times with you said self-directed IRAs or self-directed 401ks, Ken?
No, IRAs.
IRAs. Okay, so self-directed IRAs, you're only going to be limited by the custodian that you use in most cases. So let's say, for those that are not aware, within some 401k plans comes the option to take your money out of the 401k and manage it yourself from an IRA. You're still employed at the employer. You can still put money into the account as though you're still working there, like a 401k contribution, but you roll it out into an individual retirement account. So while you're working, you still have the opportunity to self-direct your money. What that does is it opens up a wide variety of investment options instead of your 401k, which usually only has 10 to 20 holdings that you can choose from. Most times with the self-directed IRA, you can almost always put some active money managers in there. There are mutual funds that you can do it through, and there are ETFs that you can do it through. An ETF is an exchange traded fund, very similar to a mutual fund. But most times with self-directed IRAs, you can do almost anything within there. You would simply be limited by what your custodian would want to hold. And then if your self-directed IRA, or if it is a 401k rolled out into an IRA, if there's still any company involvement, they would almost always tell you what you're limited by in the agreement for the account. But yeah, self-directed IRAs and self-directed 401ks too, you're almost always able to invest in anything in those accounts. Okay, cool. So let's talk about bond yields and interest rates. Bond yields are something that is sensitive to interest rate hikes. Okay, when I talk about an interest rate hike, I'm talking about the US government treasury going up. Okay, so bond yields and interest rates. So interest rates are relatively low right now. And we have a Federal Reserve that's indicated that they do not plan on very much direct impact on interest rates for a couple years yet. Now, their direct impact and what they say that they will do to the Federal Reserve rate changes, it seems like, with every meeting of the National Board of Economists. But simply to say, bond interest rates are very, very low right now. Federal interest rates are very, very low right now. Interest rates having a direct impact on bond yields and prices is something that we will need to look at, because chances are over the next couple of years, the Fed is going to raise rates. Government rates are going to go up. If you look at the 1 to 2 10-year treasury or whatever you want to look at, all of the rates are much, much lower than they were prior to the pandemic. And just like what happened during the Great Recession back in 2008, eventually these bonds start to go up in price. Well, as interest rates rise, bond yields will go up, but bond prices fall down. I'll talk about that relationship on the next slide and what that really means. The inverse of that, as interest rates fall, yields also fall and prices of bonds rise. This is an inverse relationship, making bonds an unattractive investment vehicle in a rising interest rate environment. How does this work? I'm happy to show you guys. So right here, and you guys have like a little window you'll probably be able to toggle that might have my video in there. You should be able to minimize that or at least move it out of the way of my drawing. So I'll try not to take up the whole screen here. So here's your bond. You decided that you wanted to purchase a bond for $1,000 and your bond is giving you a 5% rate of return. So what that means is you lend $1,000 to a company, and that company is going to give you $50 per year for the duration of the time that you hold that bond. And then at the end of that duration, they return your $1,000 to you, and you get to keep the interest that you've made while you've held on to it. So that's how a bond works. Now, bonds have something called duration risk, okay? Duration risk is simply the risk that an interest rate change will affect the value of your bond. And to keep things really, really simple, we are going to give your bond a duration of 5. That's not uncommon. Some bonds have a duration of 1, some bonds have a duration of 10. It's neither here nor there, it's just another number. So what happens is this is treated like a seesaw right here. So if you have an interest rate hike where current rates go from 5% up to 6%, the value of your current bond is going to go down when the value of new bond or the rate of new bonds goes up. If you have a duration of 5, you multiply this by the percent that the bonds change, and that gives you your percent that you lose if rates go up. So you go from a bond worth $1,000 down to a bond worth $950. And if you decide to go sell your bond right now, and you just held it yesterday, and now the rates have gone up and it's worth $950, you're going to get $950. You'll no longer get your $1,000. If you hold it to the end of the bond duration, to the end of the amount of time that the company committed to you, you may or may not get all of your money back depending on how the bond is set up. But as far as interest rates and how it affects current bond values, this is a direct inverse relationship. And if you have a very bond heavy portfolio, you probably want to hedge your fixed income a little bit and make sure that it's not all in bonds or not all in fixed annuities or not all in individually selected structured notes or whatever. We talk about a diversified approach. This is a really, really good time to take one because bonds are going to be under strain and they currently are under strain. So questions on that?
So far, I have no questions.
Okay. I'm not sure, if I've explained this to you guys before, if Ron's explained this, or if you've heard it before or anything like that, but, bond rates and how interest rates impact them. I mean, it's really important to not only know, but it's especially important to know right now when we're in an environment that's going to, potentially cause issues with bond prices in the near term. Okay. So you can ask any questions about anything we've gone up at this point. As I said, I'm going to try and keep everything between 30 and 40 minutes and then do Q&A at the end. I'm happy to stay here for as long as you guys want to, if anybody does have any questions, but we'll just keep on rolling here. So we are in an economic recovery. It might not feel like it based on lumber prices. It might not feel like it based on gas prices. The fact of the matter is people have a lot more money right now than they have in many, many years past. And we're a country that's operated by corporations, and corporations are going to take advantage of it. And so when we have more money and more spending power, wouldn't it be silly if Home Depot didn't increase their 2x4s from $8 up to $12 so that they could price gouge us once we get stimulus money, and that's what corporations do. I've heard a lot of people throw around things like hyperinflation and some of the things that I don't worry at all about. It doesn't keep me up at night. It doesn't stress me at night. I think hyperinflation is something that can happen to a third world country if they get taken over by a country like ours or Russia or China, if they have good commodity resources. That's when hyperinflation happens, or when there's political risk and a genuine uprising. But not very often would a developed country like the United States experience something like hyperinflation. So we have to understand what companies are doing just to gouge us a little bit on prices, and assume that most things like that are going to be short term. Here are some interesting facts about our economy right now, and it does give us some indication as far as where we can go to invest. So the rate at which people are quitting jobs is the highest since 2000. A lot of people don't think that's a good sign, but what that means is there are a lot more opportunities out there than there currently are workers, or at least a lot better opportunities. These opportunities don't come because businesses are just injured, but it also comes because some businesses adapt and become more profitable through times of economic depression. And that's a lot of what's drawing new job generation and current job switching, is the desire to work for adaptable and forward-thinking companies. So there's a trend in addition to just a normal recovery going on right now. Debt service burdens are the lowest since 1980. That's incredibly notable. It's 40 years worth of debt service ratio calculations that they have in here. What this is the amount of money that you spend on debt every single month versus the amount of money that you bring in every month. That's your debt service ratio. So what this means is people over the past year and a half, as they haven't been traveling as much, haven't been using cars as much, working from home, no more commute, companies are paying you a little bit to get better internet service, the government stimulizes you 3 times. All of these things are kind of just a recipe for us as individuals to have more spending power. And part of that spending power is gained through paying off debt. So pay off debt, everybody has a little bit more spending power. With spending power comes spending not only on necessities, but also on niceties. So this provides a good opportunity for folks, if you still believe there's some getting out there and some airlines, some cruise ship stocks, some of these things that are starting back up, I would expect a very long and drawn out recovery for these sectors, because there's a lot of people that have a lot of money to spend on some of these nice things, not necessities.
Niceties. That's an interesting word.
Oh, yeah, niceties instead of necessities. I know you learn little fake words here or there. The rebound, what this triggers. It's triggering a few different things. We have labor shortage right now. I just read an interesting article today of states that have cut off their federal assistance for unemployed. They are getting no more quickly people applying to new jobs. It's like they cut off the feeding tube, but nobody's going to find a new one. Nobody's going to find a meal or anything like that. I'm, again, not sure if this is just because people have more spending power currently and they're not incentivized to go find new work or what, but it's really interesting that the thought process is, well, we're going to cut people off the government teat and they're going to go apply for jobs faster. And it's just not happening. So interesting situation there. Shortages of goods. Where you go to invest in places like this is really just who you think is going to receive the residual effect of the catch-up. So, when you have shortages of goods, you almost always have shortages of raw materials. I have a client who works for Big Dutchman. He talks to me about the amount and the cost of shipping steel these days, so if you want places to invest and you've typically stuck to like gold and silver as your commodities, there may be other commodities out there for you to look into, raw materials, mining operations. Some of the companies that are even trying to make mining operations more environmentally friendly by using less fossil fuels. So there are some residual impact investments that you can make piggybacking on the shortage of goods, shortage of labor, and shortage of raw materials. What this results in is an increase in price of operation for manufacturing and industrial, increasing price of operations. Gas is more expensive, machinery is more expensive, raw materials are more expensive. If you think you're going to like go buy a bunch of Caterpillar right now and experience a bunch of profits over the next couple months, you might not, because they might not be making any money recovering from the economy. But if you take a position in a company like Caterpillar and build it over the next year or two and hold on to it for 5 to 7 years, anticipating Caterpillar as a company might recover very well out of a pandemic situation, that's how you might take a position in an individual holding, backing off of these theories, these philosophies, what's happening, triggering this turmoil.
We do have one quick question.
Yeah.
Actually, a couple quick questions.
Okay.
So it looks like this is regarding price gouging.
Okay.
So historically, when price gouging has ended, did the prices revert back to the original price before they were being gouged?
Okay, so price gouging, do prices return back to normal levels after prices have been gouged? I will say yes, and then put a big fat asterisk next to that yes. I will say yes, okay. They return back to a level, okay? Hardly ever does something inflate really, really quickly in a short amount of time and then just stay there. Hardly ever. When talking about anything, stocks, bonds, whatever, hardly ever does it just go up real quick and then stay there, okay? A lot of times what you'll experience, kind of like the tech run up at the beginning of this year or the tech run up at the end of last year or whatever, is you experience this really rapid growth process in the price, in the company charging more for whatever goods they want to charge more for. And then they will bring that back down to where people are still demanding it, but their supply levels can keep up with it. So just think real basic economics, supply and demand, okay? There's incredible demand for raw materials right now, incredible demand for goods, services, labor. It's taken me a month to get new flooring for my flooded basement. Okay, and it used to take like 4 days or something like that, and somebody had it in the back storage room. When you have situations like when you have the price gouging like that, I would expect that it would regulate eventually. But like, let's take 2x4s for example, right? I mean, prior to the pandemic, they were $8 for a 10-footer, I think. Post-pandemic, I think they got as expensive as $15, depending on where you purchased it. And now it's going back down. A lot of people use labor prices thinking that was a good meter for inflation. I mean, it might be part of it, but the price of lumber will likely go down, but I don't know that it's ever going to get back to $8, because what have companies been doing year after year after year leading up to the pandemic? They've been trying to cut costs. They've been trying to reduce things so that they can keep up with their competitors. And so if they've been cutting costs and not as profitable, and then all of a sudden they're twice as profitable and they don't have to lower it back down to where it was before, you'll see regulation, but it will likely still be inflated for some time. I don't know that it will ever depress to where it was before, but certainly. Okay, did that answer that question? I hope so.
Yeah.
Any other questions, Beth? That you have?
Not at this time.
The last note here, Fed rate influence in question. The Fed, the Federal Reserve Chair specifically, has indicated that they do believe that we are strong enough as an economy right now for the Fed not to do too much quantitative easing like they typically have done in the past. Some notable things that are different coming out of this pandemic than any recession in recent memory. I mean, we're sitting on $5 trillion. That's never happened before. It's never happened where we've encountered a recessionary environment and the government has literally just thrown as much money as they possibly can at the economy in the hopes of keeping everything afloat. And so really what I started talking to people about during the pandemic, but it could even ring true in the future, is where you have an economy maybe that's struggling, but a market that's very, very strong, because the market is based on company profitability and company projected earnings. And if we're coming out of a pandemic and companies are price gouging and getting 50% more profits than they have in years past, then chances are these companies are going to have pretty large projected earnings in years to come. So, the Fed and how they influence rates could certainly impact that, but their mantra lately has just been, we're going to let it go for a while without too much direct influence. So at least the Fed believes that we're in a pretty strong position economically, so that they are not stepping in to fix anything at this point. I'll say fix in quotes because I used to work for the federal government, so I know how they actually fix things. Okay. If you don't have any more questions about the economy and recovery, all of these bring good investment opportunities. I mentioned a couple companies in here. I'm not specifically recommending those companies for any one individual, but I do think that, based on areas that you particularly feel like there is buying opportunity in, you're more than welcome, and we actually encourage you to start building positions in particular companies, individual companies, over time, just to diversify your portfolio if you truly do believe that one company is going to do better than another over the next 5 years. So we're always open to that. We are right in between my 6:30 and 6:40 window, so I'm going to breeze through these last 2 points. These last 2 points are not necessarily how to identify current investments, because we kind of just went through that with the recovery economy, and how to do stocks versus bonds, and the biggest threat to bonds right now being rising interest rates, and that our rates are very low. If that all doesn't make sense, it typically, for me, means I'm going to emphasize a little bit less on the bond front and a little bit more on the stock front. So how do we do that? You have to figure out what your time horizon is with your money. So how much recovery time do I have if I take a loss? If I take a 20% loss today, and I'm currently taking money out of my portfolio, chances are I'm not super happy, because taking a 20% loss and taking money out of the portfolio exacerbates the loss, makes it worse, and then you have to become more aggressive to make your money back if that's your goal. So your time horizon is best analyzed through a risk analysis. We develop portfolios based on the time horizon concept. I didn't put percentages in the models that I put below, but just very, very simply, when you have a conservative portfolio down here, you are almost always going to be very heavy in bonds, very low in stocks. If you have a moderate portfolio, you will almost be 50-50, but you'll almost always lean a little bit heavier stocks than bonds. Usually with a moderate portfolio, you decide to have between 60 and 70% in your risky category, which is what we're calling stocks in this case. And you'd have about 40% in your bond portion, or your safer portion. No investment's safe. This is safer. And then your aggressive would be almost all stocks and very, very little bonds. If you have an aggressive portfolio, typically you don't need this money for 10 plus years, and you can take really significant losses currently in exchange for longer capital appreciation. So that's time horizon and how to apply it with everything we've gone over up until this point. And now that you know what type of portfolio to design for yourself, how the heck do you buy things? So we are going to talk to you about dollar cost averaging, and this is going to be the last thing that I talk to you guys about. So dollar cost averaging is how to integrate all of the things that we talked to up until this point. You know how many stocks you want, you know how many bonds you want, you know if you want active or passive management, whether you want to beat the market or just keep up with it. And now that you've designed your portfolio, how do you buy it? So dollar cost averaging is a fancy way of saying we're going to integrate money into an investment strategy over time. It involves purchasing securities over time rather than all at once, and this decreases purchase price risk and spreads out purchase prices over time, helping to alleviate the risk of buying at a peak. Okay, how many people have bought an investment at a peak? I mean, I know I did. I had a lady come up to me and told me that she bought Dogecoin. If anybody knows cryptocurrency, she bought Dogecoin when it was at its peak at 71 cents per share. And it was there for like, I don't know, an hour maybe. and it dropped to like 40 cents shortly after that. Okay, so dollar cost averaging helps to alleviate that risk. Okay, what you're doing is instead of doing a lump sum investment, you're going to do monthly investments. I'm going to go down here and show you how this works. So you have a lump sum investment up top of $8,000, and you purchase all of that at $10 per share. Your average price for your share is $10 per share. Average price over this time frame is $10, and your unit cost per share is $10. You invest $8,000 all at once, you're buying at $8. Now, return on your lump sum investment right here is 0%. That's because you started at $10 and ended at $10. That means if you bought everything when it was $10 and you ended when it was $10, you're exactly where you were, no matter what the share prices were in the middle of these things. Now, taking that return and then spreading it out over 8 months, rather than buying everything at once, you can see how in this example, and of course it's just an example, but in this example with your monthly investment, you're buying at a variety of prices. You purchase $1,000 worth of shares at 10, $1,000 at 14, $1,000 at 9, 13, 8, 8.5, 7.5, and 10. So you did the same amount of investment and your initial price was the same, but because of the volatility in the months coming after your initial month, you were able to buy at a variety of prices. Now you can set the rules, you can set whatever integration strategy you want to. I typically don't like to buy everything all at once when I'm integrating money, and typically we'll do 3 to 4 months to implement a full strategy, sometimes longer, sometimes shorter, depends on the client. But the point of this is it's the same amount of money over the same time. And even though you ended at the same price, your return is drastically different. You bought several shares under $10 per share. You bought a couple over $10 per share. Your average cost is $9.61 instead of $10 because you decided to buy over time rather than all at once. So that's how you do dollar cost averaging. It's a very, very fancy and very jargon-laden way of saying, I'm going to do this strategy. I'm just not going to buy it all at once. I don't want to be caught up in a wave. I don't want to be one of those people that says, oh yeah, tech is doing really, really good right now, and then buy everything in the beginning of February 2021, and then March happens and everything goes down 20%. So it's a way to integrate without taking too much risk. And once you've alleviated all of the risks that we've talked previously about, this is simply the last one to say, I'm not going to buy at a peak. I'm not going to buy at a trough. There's no way to time the market. I'm just going to do my best to buy low share prices over time. So that's what we like to do there. So that's dollar cost averaging.
Nolan, would you say dollar cost averaging could be time consuming strategy because you have to constantly kind of watch the stock market? Or
I don't think so. I don't think that it would be too time consuming because you're not necessarily watching the market to make decisions on when you want to buy things. Most times with dollar cost averaging, what you're trying to do is take the emotions out of it, where if you have, let's say, $100,000 or something like that, you just decide, hey, I'm going to split this out over 4 months. I'm going to do $25,000 a month, and I'm going to do that on the 16th of the month, each month for the next 4. Okay. That takes the emotion out of it. And it also takes the time out of it too, because you have established a rule and you know what that rule is. You are not a market expert. And I mean, I know a lot about the market, but I wouldn't consider myself an expert either. There are too many things to learn about the market. However, you can create rules, and some rules-based activities do definitely help. And dollar cost averaging is one of the best ways just to alleviate that risk that you're buying everything at a max price, or you're buying everything at its absolute peak. So, it can be time consuming. It depends on the way that you develop your portfolio. Most times I encourage people to set up rules so that you're not being emotional about the way you invest. I talk about emotional investing sometimes. There's a really cool report called the Dalbar report that goes through individual investors versus inflation. And over the past 20 years, inflation's at about 2.9%, and the average individual investor has only earned about 2.6%. And it's because they're watching the market. It's because you get emotional, and it's because you make emotional investing decisions. I try my best to take emotions out of it, because it certainly hurts me when people lose money, and it hurts me when I lose money too. But none of what you invest in the market is guaranteed. So if you're already taking a risk, this is just another way to alleviate it when you're integrating strategies, for sure.
No other questions at this time.
Okay. So what everybody has an opportunity to do, I think most everybody that's on here is already a client. And if you're not, if you've heard from us before, we'll always offer a consultation to everybody that's here. Some of the things that I didn't talk about today, but I think are very important. And whether you meet with Ron or whether you meet with me, it's important to talk about these things. Number one, just how am I allocated? What's my risky versus safe proportion of my portfolio? How much do I have in stocks or stock equivalents versus bonds or bonds equivalents? And then do a risk analysis. So actually go through another one and say, okay, how comfortable am I losing money? How comfortable am I with the idea that I'm not going to touch this for 5+ years? Because even if you work with us, things change. Things change within a 2 to 3 month period. You could have a totally different risk tolerance post-pandemic that you did during the pandemic, that you did prior to the pandemic. So it's just important to touch back on your time horizon, touch back on your risk tolerance, and just make sure that you're invested the way that you should be. Make sure there's no mismatches with what your preference is and what your performance is actually going to do, what your portfolio will actually do for you. So, yeah, if anybody has questions, shoot, I'm game. I'll hang out here for as long as you guys want to. If anybody has questions, specific to this stuff or other stuff, if you want to unmute and just ask it, you can also use the chat feature in Zoom. Happy to ask or answer any questions that you guys might have. So thank you all so much for coming tonight. We had a pretty good turnout. I recognize a good deal of the people that are here. So I'm happy that you guys were able to come out. I hope that you learned a little bit of portfolio construction, how some of this management works, how we're developing things post-pandemic, and the methodologies that are in place today may not be here 1 year from now and may not be here 5 years from now. I plan on adapting to different economic circumstances. So, if we do this same seminar a year from now, could be totally different than the one that we do today. I just want to keep you guys up to date on everything and make sure that you're feeling educated and well informed. So thank you all so much for coming. As I said, I'll hang out here as often as you, or as long as you guys want to. So holler at me if you have any more.
I just want to remind everyone, we did record this presentation. After the presentation has been cleaned up, I will be sending out the recording to everyone via email, along with a survey. If you could please give us some of your feedback. We value that feedback, everyone. We want to keep improving. We want everyone to keep coming to these things. So please feel free to fill out that survey. We'll also send out a Calendly link that will give you an online access to Nolan's calendar so that you can schedule a 15-minute phone conversation, whether if you want to just ask him questions about this presentation, or if you want to ask him questions about your personal finance and your portfolio, please feel free to schedule that time. You're also always welcome to give us a call at our office. The phone number is listed on this last slide here that Nolan has up, the 616-301-2581, and I will be happy to schedule that for you. But yes, if you have any other questions, please go ahead and unmute yourself and ask. Otherwise, this presentation is now at its end. Thank you so much, everybody. I'm looking forward to those emails. We want people to sign up for the raffle, so don't forget to shoot me an email.
I had a question, Nolan.
Yes, sir.
Yeah, the question, of course, ARC was something that I had invested in. Is that something that you would dollar cost average, since the bottom kind of fell out of it a while back?
Say the investment again, Aaron.
Yeah, it was ARC.
Oh, okay. Yeah, so that strategy in particular is something that I would imagine that we would change, allocations to over time. I know that a lot of the reason why, we did take some funds out of ARK Invest for a while, had to do with their, effectively the way that they manage money and what propensity they can work in. They updated a lot of their disclosures. They updated some things to abide by the SEC as far as like what percentage of ADRs they can have in the portfolio and how much they can hold in one individual company. I just talked earlier today with a guy that represents their fund, and so I expressed some of those concerns. I think on an ongoing basis, they're not going to get incredibly crazy with the way they allocate or over allocate into any one individual company. So I imagine this is one of those ones that maybe we will add in and take out of a portfolio depending on market conditions. It's one of those actively managed funds, which I mentioned don't have the same holdings month to month. So it's very possible that 3-4 months from now, when they've adjusted their holdings, we're much more comfortable with the lower 60% of what they have in the portfolio. Sometimes they just get a little too volatile and a little bit too aggressive, and the bottom drops out a little bit.
Were they just
Go ahead, Aaron.
No, the problem was the problem what they were too tech heavy or something? Is that kind of what when a lot of the stocks or the tech stocks really tanked?
Yeah, well, I think the problem has to do with the fact that they're a money manager going after a very niche market. Okay, so there is a tech sell-off for sure, but a lot of the holdings within the ARK funds, in particular, the actively managed funds, they invest in companies that don't have profit. They invest in very small companies. They invest in companies that might not have profit for another 2-3 years. And so whenever there's a tech sell-off, usually the very, very small companies that are non-profitable at this time get hit the hardest. And so that's why you would see some losses exacerbated in, a holding like an ARK fund, whereas like over the past month or so, they've blasted any index that you can possibly look at. And that's because on the other side of it, they have tremendous capital appreciation opportunity. But yeah, I mean, tremendous risk in those things. They do invest very heavily into tech and in healthcare, and they do niche investing, and niche investing is very volatile. So, it's good to be there as long as you have the appropriate time horizon and can take that risk. If you don't like the idea of one individual holding going down 50 or 60%, it's probably not the one for you.
Yeah.
Nolan, I do have a question from Facebook.
Hey.
Should we take profits on the way up? If so, is there a calculation to determine when to rebuy in on dips?
Yeah, rebalancing on the way up is a very prudent thing to do. Essentially, what you're talking about is just locking in gains as something appreciates. There are a couple different ways that I'll answer that question. I have some clients that just have very, very small holdings. So maybe they buy 10 shares of something, okay? And they buy 10 shares in something that's very low cost. And once the share price doubles, they'll sell half of what they originally invested. So they get all of their money back. And then they'll continue to hold on to the other half of that stock, hoping it continues to go up in the future. So that's the way that some people do it. You purchase and then sell once you're profitable, and then keep your profits invested and reinvest the principal, reinvest your primary investment. So that's one way to do it. Another way to do it is just like you talked about, how you can purchase something at a certain price and it goes up to another price, and then you sell, and then you get back in at a lower price once it's gone down. So you can do that with options. You can put like puts and limits and different things like that on your stocks, where you come to me and you say, hey, I want to buy 100 shares of MasterCard for $20,000 or whatever MasterCard currently is. I think it's $200 a share. But you want to buy $20,000 worth of that. Well, you can then set those parameters. I think MasterCard's going to go up 10%, and I think at most it'll go up 25%. So then if you say, okay, I'm going to put a limit order on my stock so that it's automatically sold once it goes up to $220 per share, it'll be sold like that. And orders like that are good for 6 months. And then you can decide when you want to get back in. I don't think there's a blanket rule as far as when to get out and when to get in, because IBM moves differently than Facebook, moves differently than Apple, moves differently than Visa does. So all of these stocks move differently, all have the potential to go up and down drastically different from one another. I've done some of that rules-based investing before where you simply designate an upper and lower limit. What are you comfortable gaining? What are you comfortable losing? And then putting in contracts above and below that price so that you limit your potential for loss. Most times done with options, but you can certainly do so manually. My preference when I'm developing my own portfolio, I just like to see double-digit rates of return. So if I'm, building a stock position and all of a sudden I've gone up 12% in that stock position, I'll just sell all of it and I'll go find something else on sale and I'll hopefully get another 10 to 12, 15% from that holding too. So that's the way that I do it. Everybody does it a little differently.
Nolan, I have a question.
Yeah, yep.
Are preferred shares kind of bond-like investments, whereas the interest rates go up, the price of the preferred share will go down?
Kind of, yeah. Preferred stock is much more like a bond than it is like a stock. It's issued at a par price, meaning like it's a set predetermined price that they are trying their best to keep the share price around. So if you buy like shares of a preferred stock, real estate investment or something like that, they may have a par price of $25 per share. So you go buy it and maybe you get in at 24, maybe you get in at 26, but hardly ever does it move much more than 10% either way of par price. Preferred stock gives you, similar to a bond coupon, gives you an annual rate of interest. And if you sell your preferred stock down the road at what you bought it at or greater, then you can experience a little bit of profits there too. But they almost always hover around their par price. They give out something very similar to interest that a bond does. Preferred shareholders have to get paid their dividends first before any common stockholders get paid dividends. So that's part of being a preferred shareholder. You're higher up in the credit stack. So if like a company declares bankruptcy, they pay bank first, they pay bondholders second, and then they pay preferred stockholders third, and then common stockholders fourth. So you kind of, etch yourself up in the company structure if they ever go bankrupt. But yeah, very, very minor differences. Typically preferred stocks are going to be centered around real estate and utilities. So you're kind of going to limit yourself from, sector diversification, but yeah.
Okay, thank you.
Yeah.
Yep, thanks.
Yep. Okay, you
Any
folks,
other
anybody else have any
questions?
questions? Okay. So from here, if anybody wants to, you can click that link that Beth just put in the chat. That's for a site called Calendly that can just link up to my calendar. I have some time Wednesday through Friday next week. So if anybody just wants to call, do a portfolio checkup, make sure you're invested the proper way, whatever you want to do, feel free just to schedule some time with me. It doesn't matter if you talk to me or talk to Ron. We like to be pretty interchangeable most times. So happy to talk to you guys about that and make sure you're invested where you should be. So thank you guys so much for coming tonight. Holler at me if you need anything. You know how to get a hold of us. We're very happy that you guys came. I look forward to talking to you next time. So let me know if you need anything.
Thanks, Nolan. Appreciate it.
No problem.
Have a good night, everyone. Thank you so much for joining.
Yep. See you later.
Yeah.